Welcome back to the channel. I'm Matt Nelson, and today I've got my partner, Matt Finley, with me, our Chief Investment Officer. Thanks for coming on, Matt, and explaining your thoughts on the market outlook.
My pleasure.
We just released the Q3 2026 market outlook, and honestly, the market's defying a lot of expectations this year. And whether you're one of our clients or just watching as an independent investor trying to navigate your own portfolio, we just want to break down exactly what's happening with inflation and tech spending and interest rates and what that actually means for your money over the next few months. So, Matt, let's just jump right in. Q2 turned out a lot better than most people anticipated. Speak to that a little bit.
Yeah, it was pretty wild. Starting the quarter, we were pretty flat on the year. And then, of course, we had the Iran situation blow up, and that impacted oil specifically amongst a number of other things. Markets quickly dropped around 9% from there. And as it started to move on or labor on, markets started to recover. Story comes back to what moves markets over time, not the noise of current events, but actual company earnings, revenue, and so forth, and rallied up a little over 13% from the market bottom. And as of today, we're sitting a little over 8% on the year, up amazingly.
Yeah, that is pretty amazing, actually. I mean, like you said in the report, there was this 9% drop early, got all this geopolitical stuff going on. But, why do you think it's so resilient right now?
Yeah, I mean, earnings have been absolutely spectacular. Probably some of the best earnings in my entire career. They blew away expectations. And while AI spending and tech spending has been a major driver in that, it's actually spread to the rest of the economy as well. So it's not just a handful of names driving it, and hence the whole market has actually moved forward. And more importantly, forward guidance has been a spectacular beat as well, meaning of what companies are saying that their projections are over the next 6, 12, 18 months is exceeding what analysts were expecting. That gives us a little longer runway for the markets to increase, hence, the 13% move from the bottom throughout the quarter.
Well, so just as like a macro check-in, kind of top down, what are we thinking? Inflation, jobs, policy? Talk about that a bit.
Yeah, so jobs has been something that we've written about for probably the last 3 years as the anchor that's been holding things back. And in our year preview, so last December, as we wrote about this, we were seeing some potential green shoots in jobs. And as of this last month, it really does look like jobs did bottom and has been trending in a positive direction. That's great for the economy. It's obviously great for the consumer. Less people, making less money drags the economy down, and vice versa when there's jobs. So that's been a big positive. Inflation's been the sticky point, especially with oil in the Iran situation. As we talked about prior, if Iran prolongs and oil stays higher for longer, it doesn't just become about energy and oil. It starts to seep into manufacturing and delivery and global shipments, and that's what we're seeing now. But as of, a week or two ago now, we have this ceasefire, and oil prices have already come back into the mid-70s from as high as 120, but still not down in the 60 range it was prior to the Iran conflict. So we should see inflation start to come down on that basis probably in the next couple months. But it has created a little bit more of a sticky inflation situation. And the markets are actually pricing a rate increase on the year because of that. However, that's not our view. Our view is that there's probably still room for a rate decrease on the year or no movement at all. And the Fed Reserve's actual, what they call a dot plot, what their projections are on rates, is still rate cuts over the next year to 2 years.
Interesting. Yeah, and just for reference point, we're recording this, June 23rd. It might come out a week or two after, and so much is changing so fast. It seems like all the time, but for sure this year, for some reason, this article we put out actually probably about a week and a half ago at this point too. So not that any of this is necessarily stale, but it has, things have even evolved in the 3 weeks probably
Right.
since you'll hear this in writing, the writing of it. So yeah, well, that obviously everything you're saying there then just supports a little bit higher S&P target. I know you'd talked about in the past somewhere like 7,400 range on the S&P, and now you're pushing that up to maybe as high as 8,000.
Correct.
You think that's still viable?
Absolutely. So it's, in fact, I don't think I've ever increased a year-end target mid-year. I just stick with kind of the estimates that we have start of the year, and if it beats it, great. If not, and just kind of analyze it later. But because of the amazing earnings beats
Mm-hmm.
that we had this quarter across the board, we've seen small and mid cap stocks doing very well through this point of the year. That's breadth developing in the market. That's not a bearish or recession signal. That's usually a further bull signal. Again, what we just talked about with interest rates could be a little bit of a fly in the ointment type of situation. But because I like to do projections based on earnings growth potential. And so if futures earnings are accelerating, then I wanted to make that adjustment here mid-year. So yes, our target coming into the year was around 7,400. That's actually where the market's at today. So I did elevate that a little bit from about 7,650 to 8,000 range. That's only about a 2 to 4% increase in the target on the year.
Yeah, some modest increase, but still
Correct.
Even better than initially planned anyway. Well, not to be redundant, we did speak a little bit about inflation, but the Fed and the inflation, discussion is kind of this elephant in the room. And so, basically talk about the consumer and the Federal Reserve. There's been a lot of chatter that they're going to keep interest rates higher for longer, and it's really due to those sticky oil prices.
Right. Yeah. So if inflation is higher, the risk of reducing rates into that could cause a much worse inflation scenario down the road, which is a lot harder to deal with once you let it run away. So think of 21 into 22, where the Fed didn't do enough against the pending inflation. Hence, we got the over 9% inflation at one point. That is the fear. And of course, we have a new Fed president in Warsh. So there will be a little different communication and tactic and how he'll lead the Fed moving forward. But that is the concern. So, of course, the consumer wants to see a reduction in rates. Yeah. Because that means your lending is less, your mortgage rates are less, which is a concern right now with mortgage rates still well over 6%, making it difficult for the housing market to keep moving. And so there is some pressure there. The consumer wants to see it lower, but the Fed has to control inflation in our country, otherwise it can get out of control. Now, that being said, the Treasury Secretary and Bezant and White House communication has been throwing out higher inflation for longer is a good thing in the realm of outgrow debt. And that is true if it's managed properly. But the last part, if it's managed properly, is the key part of that.
Yeah. The wild card there. I mean, it just speaks to within wealth management. That's why we can't really time this stuff exactly. I mean, it's especially when we're talking about macro things like Fed and now I've got a Fed chair change and just some of these very big levers. We just have to build a strategy that's going to succeed regardless and make small adjustments along the way. And, everybody has their own index they need to sort of track to. We don't have to track to the market. We track to your own retirement index, if you think of it that way.
Yep. And we did just reduce our portfolio about 5% on the equity across our entire book of business. And so that sounds a little counterintuitive to what we were just talking about, that we increased our year-end target and that we do think there's a little longer to go in this current bull market. But what it comes down to is how much further does it have to go, and do we still need to take that much risk? And if the Fed does start reducing rates, whether it's later this year or early next year, that becomes a very large tailwind to bonds. And so if you can get 6 to 8% in bonds and maybe 8 to 10% in stocks, why be all stocks at that point? Like you're adding too much risk for marginal difference. So that's part of the reason why we did pull back a little bit, a very small portion, and we're not looking to do any more in the near term. But that's the reason for that.
Yeah, I mean, I love that move. We talked about it a lot before you made that, and I know you make the final call on a lot of things. But as we're meeting in the owner group and just discussing that kind of thing, it just shows that we do need to take some chips off the table once in a while. And as you said, what's the risk reward trade off there? We don't need to time the market exactly, just to make small moves at the edges and stick to strategy.
Exactly. And the reality is the average bull market lasts a little over 100% from bottom to top. Obviously, the bull rally out of the Great Recession lasted over 400% in 12 plus years, but the average is a little over 100%. We're currently sitting at 109%. That doesn't mean bear market's coming, just means how much further will it go?
That's right. Yep. Yeah, I appreciate your insights. I mean, everybody watching at home, clients, I know they appreciate hearing these updates. And if we can be help, or you want a second opinion on a portfolio, if you're not a client, just let us know. Happy to have a chat. But we just want to wrap it up there. We'll leave a link to the article in this video, and likewise, the article, I have a link back out to the video. If you want to cross-reference, definitely go read Matt's article, even if you skim it, so we have some understanding, and bring your questions with you to review meetings. So with that, let's just wrap it up. Make sure to like and subscribe, and we'll see you later.